Taxes.
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 Taxation.
Taxation.
Hold on, baby. Hold on.
Tax refund.
Taxes in the United States can feel like a never-ending drain on hard-earned money. Most people accept it, filing away every year without a second thought, hoping for a decent refund at best. But buried within the thousands of pages of the tax code are legal strategies that can make a world of difference. Tools that the wealthy and savvy have been using for years to hold on to more of their income. The truth is, paying less in taxes isn't about bending rules or hiding money offshore. It's about knowing the rules that already exist. Rules designed to reward smart planning and strategic decisions. From overlooked deductions to tax-efficient investments, there are entirely legal ways to reduce what you owe significantly. In this video, we'll go over some of the best ways you can save money and reduce your tax bill. You should take advantage of pre-tax commuting benefits. If you use public transportation, ride-sharing services, or parking facilities for work, you can save a lot of money on commuting expenses. In 2024, workplaces allow employees to spend up to $315 per month tax-free on commuting, which amounts to $3,780 in annual tax savings. These commuting benefits apply to mass transit like trains, subways, and buses, as well as ride-sharing services like Uber and Lyft. You can also use these benefits to cover parking expenses, including parking meters, garages, and lots. If your employer offers this, don't let it go to waste. You should also maximize your retirement plan contributions. One of the smartest financial moves you can make is contributing to your retirement plan. Most workplaces offer retirement plans like a 401k or a 403b. If you work for a for-profit company, you'll likely have access to a 401k, while government and nonprofit employees often get a 403b. Contributing to these retirement accounts helps you in two ways. First, the money you put in reduces your taxable income, meaning you pay less in taxes this year. Second, it allows your money to grow over time, giving you a more comfortable retirement. Although there are other types of retirement plans, 401ks and 403bs are the most common. If your employer offers a matching contribution, it's even more reason to take advantage of this benefit because that's essentially free money. Another thing you can do is use an HSA for tax-free medical expenses. If you have a high-deductible health plan, you qualify for a health savings account. HSA. This is a special savings account that lets you set aside money for medical expenses on a pre-tax basis. Every dollar you contribute lowers your taxable income, which means you pay less in taxes. An HSA works like a savings account for health-related expenses. When you use the money for qualified medical costs, you don't pay any taxes on it. Another huge benefit of an HSA is that the money in the account can be invested, and any earnings or interest you make are also tax-free. This makes it a powerful way to save for future healthcare expenses. You should ace-low use an FSA to pay for medical expenses. A flexible spending account, FSA, is another way to pay for medical expenses with pre-tax money. It works similarly to an HSA, but there's a catch. You must use the money within the year, or else you lose it. Some employers offer a rollover option, but if they don't, any unused funds at the end of the year are gone. If your workplace offers an FSA, it's a great way to save money on medical expenses, but make sure you plan carefully so you don't lose any unspent funds. Another way is to use a dependent care FSA for child and adult care expenses. If you have children or adult dependents who require care, a dependent care FSA can save you a lot of money. This account allows you to use pre-tax money to pay for daycare, preschool, nannies, after-school programs, day camps, and even adult daycare facilities. Since these expenses can be costly, using a dependent care FSA helps reduce your taxable income and makes it more affordable to cover care costs. You can also report capital losses for tax deductions. If you've lost money on investments, don't ignore it when filing your taxes. Capital losses, especially from stocks or cryptocurrencies, can reduce your taxable income. When you lose money on an investment, you can report it as a deduction. Many people forget to report their cryptocurrency losses because exchanges don't always provide a tax form like they do for stocks. If you don't report these losses, you're essentially throwing away free tax deductions. Pay less tax on long-term capital gains. If you hold onto a stock or cryptocurrency for more than a year before selling it, your profit qualifies as a long-term capital gain. This is important because long-term capital gains are taxed at much lower rates than short-term gains. In fact, depending on your income level, you might even pay zero taxes on long-term capital gains. This is one of the biggest tax advantages available to investors. So, holding on to investments for at least a year can significantly reduce your tax burden. Make sure to check your 1099-B tax form for errors. If you invest in the stock market, you'll receive a 1099-B tax form from your brokerage, like Robinhood or Ameritrade. This form shows how much you bought and sold stocks for throughout the year. A common mistake on this form is missing purchase price information. If the form doesn't show how much you originally paid for a stock, the IRS assumes you bought it for $0. This means they think all your gains are profits, which can result in a much higher tax bill. Always check your 1099-B for errors before filing your taxes. You should also deduct your margin interest expenses. If you've borrowed money from your brokerage to invest, called margin trading, you can deduct the interest you paid on that loan. This expense is listed on your 1099-B tax form, but is often buried deep in the paperwork, making it easy to overlook. If you've won money gambling, whether from slot machines, sports betting, or horse racing, you'll receive a W-2G tax form. The IRS already knows about your winnings, so you must report them. However, what many people don't realize is that you can offset your gambling winnings with gambling losses. If you lost money at the casino, those losses can be deducted, which lowers the amount of tax you owe. Contribute to a traditional IRA for tax savings. If you don't have access to a workplace retirement plan, or you want to save more for retirement, consider opening a traditional IRA. Contributions to a traditional IRA may be tax deductible depending on your income. This allows you to lower your taxable income while building your retirement savings. Another thing you can do is save for education with a 529 plan. A 529 plan is a tax-advantaged way to save for education expenses. While you won't get a federal tax deduction, many states offer tax benefits for 529 contributions. Plus, the money grows tax-free as long as it's used for education expenses like tuition, books, and school supplies. Also, adjust your W-4 to avoid IRS penalties. If you usually owe money when filing your taxes, you may be underpaying throughout the year. This can lead to IRS penalties. To avoid this, adjust your W-4 payroll settings to have more taxes taken out of your paycheck, preventing a large tax bill later. Make tax-free income with the minimal rental use rule. If you rent out your home on Airbnb or a similar service for 14 days or less in a year, that income is completely tax-free. This is called the minimal rental use rule. If you report this income incorrectly, you could end up paying unnecessary taxes, so be sure to handle it properly. Cutting down your tax bill legally isn't about knowing everything. It's about knowing the right things. These strategies can make a real difference in what you keep each year, but the first step is putting them into action. And if you found these tips helpful, make sure to hit that like button and subscribe for more ways to keep more of what you earn. Don't forget to turn on notifications so you never miss out on future videos packed with strategies to help you build and protect your wealth. Thanks for watching, and see you next time.